All right, good night, everybody. If you're on tonight with us and you're hearing and you're seeing our screen, just give us an HS in the chat. Good night, everyone. If you are on with us tonight and you are hearing and seeing, just give us a HS in the chat. So if you're on with us tonight and you're hearing and seeing our screens, just give us an HS in the chat. All right, if you're on with us, you're hearing me. If you're hearing me, just give me a HS in the chat. If you're hearing and seeing our screen, just give us an HS in the chat. Great, wonderful. Let's get those HSs. Let's just make sure you all are hearing and seeing. We want to make sure the technical things are right, and then we will go on. If you are both hearing and seeing, just give us a HS in the chat. Let's make sure you're with us tonight. All right, so there's about a 30-second delay with the chat. I hope that improves. Thank you for that as well. We want to welcome you to tonight's session. I believe tonight's session is a very, very powerful one. From what I've seen so far, it is an awesome session to be on. So I would think it would really improve your trading, whether you are advanced or whether you are basic. I think we have a lot to learn tonight and probably into the next couple of sessions with regards to moving averages. So we want to welcome you to Trading Made Simple with the Maxpips team. Tonight, Liana will be taking you through the moving average and understanding the moving average. And then, of course, when we understand the moving average, how we can apply the moving average to be successful on the market, what to look for, and those sorts of stuff. So, without further ado, I want to bring on the better part of the Max Pips team, and I want to bring on Liana to carry out tonight's session for you. Bye bye. Have a blessed night, everybody. Please uh, welcome Liana on.
Hey guys, good night. Good night to you. This is Liana, all the way from Trinidad and Tobago. I feel as if I have not been on with you all in forever. I missed you guys. Let me just go ahead and say good night to some of the names I'm seeing in the chat box. Big Squeeze, first time I'm seeing your name. Welcome. Born to Trade, how are you? Jerome Green, Flora, Mickey 83, Donnell, Crystal McIntyre. Hi, pleasant good night, good night, good night. Daniela Pear. For some reason, I'm not seeing names that familiar to me. I know Nigel, all right. So I'm seeing Nigel. It might just mean that you all were on when Maxime would have been on previously. If it's not the case, and if it's a matter of you all being on for the first time, let me know that, guys. Hey, Nigel. Bevail Mastity FX. Hey, that name very long, but pleasant good night to you. Hey, Joanne, good night. Hi, Coyote. How you doing? Ross Clay, good night. Build My Legacy. Has the session begun? It has. Build My Legacy. I'm gathering. All right. So it has. Just refresh your screen and you should get on. TL Garris, pleasant good night. Sharon, good night. Oh, you're a first timer. Welcome, welcome, welcome. First time and first ever live. Brian, pleasant good night to you. I hope this content is simple enough. And Sharon, likewise, hope it's simple enough for you to be able to follow along. But you would find that for the persons that follow us regularly, this session will be much more meaningful in the sense that here are trading made simple. We're extremely intentional in terms of what we do. That is to say, when we begin a series, when we begin a course, a content, we stage that content carefully so that preceding sessions feed into the later sessions. So, in truth and in fact, this is our segment on moving averages, but it's really meant to complement the last couple of teaching sessions we would have done. And for those of you that have been on with us, you'd remember that over the past couple of weeks, we were teaching you the basics of technical analysis. So we went through things like support and resistance, we went through trend lines, we used those two items to help us define market structure. And once we were able to define market structure using those two components of technical analysis, we went on to walk you through candlestick patterns, which was meant as a further aid to help you understand how you can pull things together to create a trading system for yourself. What do I mean by that? Well, if you know the trend, it means you know the overall direction of a particular currency pair of a particular instrument. If you are able to identify support and resistance, then you have a broad approximation as to where an instrument should buy from. We know that you normally buy off of support that is respected and rejected, and you often sell off a resistance that is rejected. All right, so you would have known that, but exactly when do you enter? The entries would have come via our discussion of candlestick reversal patterns, both the entries and the exits. So we looked at support and resistance, we look at trends, we looked at candlestick reversal patterns, and that was us teaching you how to engage in technical analysis yourself, how to become a competent charter, someone that could go onto a chart and make sense of the information that the chart is giving to you. This segment where we begin to look at moving averages is our attempt to make that that naked technical analysis a bit simpler for you. So if you're in any doubt as to whether you pulled the right trend line, if you're in any doubt as to whether that trend's strong or not, if you're in any doubt as to whether your resistance and support are valid support and resistance areas, if you are in any doubt as to whether this really does make for a good entry and exit point, then the look at moving averages should be able to help you with all of that. So again, this session is a complement to our preceding sessions. However, you can as well take the information as is. You can take the learning. Let's assume you didn't see that at all, those preceding sessions. You can stay on for this session and then you'd work backwards. You'd stay on for the session. I'm going to show you how to apply it, but then you can go back and look at our pre-recorded videos so you'll be able to follow up. All right, guys? And that is what we're about tonight. Nigel? Okay. I know your name though, so perhaps Nigel, that's what explains it. Hey, Gingerbread, how you doing? You're back from your trip? I said to Miles, one, you can't see anything, and everyone else that's on the chat is able to see. So could you please refresh your screen? Or if you look at your screen and there's a white arrow that is symbolic of a play button, just press that play button and you should be fine. So guys, we're going to be discussing moving averages tonight. And why moving averages? I'll tell you what, moving averages actually are one of the most popular and oldest technical analysis tools. What is technical analysis? Let's do a refresher. Technical analysis is where you look at what price would have done in the past so as to make an assessment of what is likely to happen into the future. And the reason we're able to look at the past to predict the future is because the market tends to present recurring patterns. And therefore, if we were able to identify a pattern that occurred in the past, we can make a valid extrapolation as to what may occur into the future. All right. And that's the basis of technical analysis. And whereas we did naked charting without any indicators, without the aid of any specific tools per se over the past weeks. Tonight, the look at moving averages will help you apply some pre-built analysis tools that can make your trading game simpler or your trading decision simpler. Hi, good night, Prashit. How you doing? Rowena, how you doing, girl? See now, son, you're the second person that's telling me that. So here's what. Refresh your screen and tell me if you're able to see, or else if there's a white button to the middle of your screen, just click on that. That serves as a play button and you should be on in the live session with us. All right, guys, so we're going to be looking at moving averages. As I said before, it's one of the most popular and the oldest, one of the oldest technical analysis tools that there are. And with that said, with that foundation being established, let me move on, therefore, to walk you through my learning outcomes for the night. Now, these learning outcomes are going to extend for the next couple of sessions because, as you know, our mandate is to make trading simple for you. To make it simple, I need to ensure that you understand things every step of the way. And therefore, we're going to take a very slow, steady, systematic, and staged approach to the information we're covering. By virtue of that, yes, I have 3 learning objectives, but I envisage it will take us a couple of sessions to be able to get through them all. Notwithstanding, by the time we are finished with our look on moving averages, you would be able to define a moving average. You'll be able to distinguish between the characteristics of basic types of moving averages. By deduction, therefore, it implies that second learning objective implies that there are different types of moving averages available for you to use. We're going to go through the basic ones because the basic ones, having a grasp of the basic ones, are the foundation towards effectively using them. All right. As you come upon the more complicated or the more complex types of moving averages, you need to trade them with a particular system. However, the basic ones can be leveraged across almost every trading decision that you need to make. All right. And lastly, our third learning objective coming out of the moving average session, I'm going to teach you 4 ways of applying moving averages. In particular, I'm going to show you how to use moving averages to help identify your trend. Secondly, I'm going to show you how to use moving averages to determine the strength of a trend. Thirdly, I'm going to show you how to use moving averages to assist your support and resistance. And finally, I'm going to walk you through how to use moving averages to assist with your entry points and your exit points in the market. So if you could briefly recap on the 4 prescriptions I said I will go through with you. Trend, support and resistance, and entries and exits. In other words, we're going to use moving average to help complement all the things we did in the technical charting lessons over the past couple of weeks. If you're okay with that, guys, and if you can appreciate that, give me an A in the chat box. Give me an A in the chat box. If you're okay with that, if you can appreciate that, if there's anything else you'd want to see relative to moving averages inside of this session, let me know as well. I'll take note of it and I'll see if I can include it in our subsequent teachings on moving averages. All right, great. So let's get started for the night. Let's start with our first learning objective. We said that we wanted to help you understand what a moving average was. So let's deal with that firstly. I would have already told you for the night, it's one of the most popular and the oldest tools of technical analysis. Here's why that point is meaningful to you. If it is popular, then there must be some merit towards the utilization of the moving average. Something that has stood the test of time by virtue of how old it is, by virtue of how long it's been used in technical analysis, should also allude to the merit ascribed to moving averages. So its popularity and the fact that it has lasting power are 2 signals that moving averages can in fact be meaningful in your trading game. So it's part of the definition simply because I wanted to underscore the relevance of moving averages to effective trading decisions. Now, When we get down to the nitty gritty of understanding exactly what it is, here's what a moving average is. It's basically a line that you install on your chart, and that line gives you the average value of data over a specified time. Let's break that point down. It's a representation of the average value of data. Average meaning it looks at information over a particular period of time, and then it adds up all that information, it sums all that information, and it gives you a calculation, sort of like an arithmetic mean, to show you what on average your data would have been representing. Let me ask you a question, therefore. If you were to think about a moving average in the context of trading, what when I use the term or the phrase value a data, what data do you think the moving average is utilizing to give you this projection, this average? What data would it be utilizing? Because the moving average is this line which averages out the value of data. The value of what data? Tell me. Let's just think about it. It's not a trick question. It's just a logical breakdown for you to start to appreciate the information and appreciate what a moving average can do for you. Let's talk about what you think that data would be. What data exactly is that line going to be projecting for you? What data is it going to be averaging for you? Hey, Marilyn, thanks for letting me know that. I will contact tech support. So that's the last Tuesday session you said. I will take a note of that. I will contact our technical department and let them know that perhaps the wrong video was uploaded. All right, so thanks a whole lot, Marilyn. Much appreciated. Welcome, Sowens. Baltimore, good night to you. Monique, you're absolutely right. Rowena, you're right. Troy, you're partially right. It's price in this instance. And I'm teaching you a basic moving average here, right? So it's price. Coyote, not necessarily. Coyote, if I probably push the limits on it, I can come up with support and resistance. But more accurately, it will average out price for you. I think pivots do a better job of giving you the average support and resistance as opposed to moving averages. Yes, daily streams, you're right. Barrow, you're right. McEmerald, you're right. Video, you're right. Yes, yes, yes. Everybody that said price action, you're absolutely right. Anthony, you're not wrong by saying candlesticks, it's just that the candlesticks give a certain bit of information, and ultimately that information is price. All right, so let's go again. It's a representation. We are saying that a moving average is a representation of the average of price. In other words, the moving average line will tell you on average what price would have been doing over a specified period. Now let me deal with that phrase that we call specified period. Whenever you are to put a moving average onto your chart, you get to decide what period or what number candles or what number bars you want that average to cover. All right, that's what we mean when we say a specified period. Whenever you install a moving average onto your charts, you get to choose how long of an average or how short of an average you want. So you could tell the computer, here's what, I want you to give me a moving average 10 that gives me the average of the last 10 bars. Or you can say to the computer, give me a moving average that averages out price for the last 100 bars of price movement, price action. All right, so that's what we mean when we say over a specified period. So all in all, therefore, I've just explained the second part of our definition. The average value of what? Of price over a specified period, simply because of the fact you're allowed to determine what period or what number candles, what number bars you want to have reflected in your moving average. Let me actually show you it on a chart so that you can better appreciate where you get to input your period, as the case may be. All right, so I'm going to be pulling up my chart now. Guys, here's this. When I'm on the charts, I cannot see the chat box. So please bear with me. I'll not be seeing a chat for a little while. Bear with me. I'm going to take off. Where do I insert my moving averages? Right to the top of your screen, there's the name of the pair, there's the time frame, there is the type of chart you want, there's compare, then there's indicators and strategy. If I click on indicators and strategy, all I need to do is type in moving average. And as you can see, there's a list of moving averages that will come up for me. There is the moving average exponential. There is the moving average. This simply means simple moving average. Whenever on TradingView, when you see moving average, it means the simple moving average. Why am I making that distinction? Because depending on the charting platform you use, they would not just call it moving average. They will say simple moving average, and you may be confused. All right. So in this case, on TradingView, whenever you see moving average, they're referring to the simple moving average. Then they have the weighted moving average, the Hull moving average, the smoothed moving average, the Arnold's moving average, the least squares moving average, the envelopes moving average. There are so many. There's the pivot moving average. There is the double EMA. There's a whole lot of them. But I'm just showing you. I'm using the simplest of them all. I'm clicking on moving average. I want to insert a moving average on my chart. So I'm clicking on moving average. And what just happened? Something appeared to the bottom of my screen. Now, if you notice, that thing that appeared to my screen, look at where my cursor is at, guys. My cursor is surrounding a box where there's MA9 close. All right? Here's how I get to change the period. As is, the computer picked up a default setting. The default setting for moving averages is at the 9 period. If I wanted to change that 9 period, all I needed to do was go across to my gearbox, which is actually my settings component, and I can change the length of that moving average. So I could have changed this to 14, for example. That's where I want it. All right. And then right below the 14, let me show you this. There's a whole lot of options for me to choose from. I could have chosen from open, high, low, close, high, low 2, HLC 2, OHLC 4, EMA, MA. I could have chosen a variety of things. Moving averages, and I'm just showing you the basic platform now, are typically set at close. So I just changed my period to 14 and the default was always close. Offset, we don't interfere with that quite frequently. So my period has just changed. My period refers to the length of my moving average. And I can OK that and it will remain okayed on my chart. And that is simply how you can change your periods depending on your moving average. Just give me a second. I'm trying to pull up your chat, guys. Right. All right. If just trying to get everything to show on my chat box, but it's not showing. I can't see the chat. All right, I'm seeing you now, guys. If you understand, therefore, how I or how you change the specified period as point two speaks to, just give me a two in the chat box. If you understand how to change the specified period, give me a two in the chat box. Coyote, we're doing a series on moving averages. I'll go through all of that with you. I just want to make sure we keep that structure so that you don't get confused because there's so much content we can actually teach on it. Rowena asked, so does the 9 mean 9 candles? You're absolutely right, Rowena. So if I had chosen 50 as Coyote is speaking to, it would have meant the average of price movement over the last 50 candles. Right, so you all understand that? You all get that? Great. There's a third point I need you to be entirely cognizant of, and that is the fact that the moving average is a trend following indicator. The word follow therefore implies that price needs to do what it wants to do first, and then the moving average would react to that. In other words, the moving average is a reactive tool. It means it's a lagging indicator. What do I mean by a lagging indicator? I simply mean it's going to give you an average of what happened, but it's going to give you the average after price has actually made its move on the chart. So the moving average is not always going to give you the earliest indication. It's not going to tell you what price will do. It simply reports on what price did. All right, it basically reports what would have taken place for you. It's trend following. Therefore, it's not likely to tell you what will come in the future. It's simply telling you what came in the past. But in technical analysis, as I started the session off by saying, what happens in the past gives us an indication of what may happen into the future by virtue of recurrent patterns that the market keeps making. All right, guys, but I need you to be aware of that. Moving averages are lagging indicators, meaning they follow price. So don't use a moving average as the sole basis upon which you make a decision to do something in the market, yes or no. Don't take it for granted that the moving average is always going to be 100% accurate. It will not be because of the fact it's looking at past information. It's not making an extrapolation into the future. We have other things to do to get it to work for us. Anthony, I explained that a little while ago. I explained that the period refers to the length of the average that you want to have reflected. And as we say, the length of the average has to do with how many candles or how many bars of movement you want to capture in your moving average, right? CJ, that's a really nice question. Yes, it can apply. Moving averages can be applied across every single time frame. And as we get into the intricacies and greater detail, I'll show you moving averages that can span multiple time frames and moving averages that are more suitable to smaller time frames and stuff like that. And let's go on to deal with the fourth point that we have here. Finally, you'll be the judge of that by the time I walk you through the end this moving average session, right? The final point in terms of us being able to accurately define a moving average, guys, is that it is better utilized when the market is trending. Moving averages move best. They have greater predictive validity. They give you a better basis to make a future trade decision if the market is trending. If your market is in consolidation, the moving average is not, you're going to have movement on your moving averages, but you're going to get a lot of false signals coming out to the moving averages. So you want to try as far as possible to utilize your moving averages if you're utilizing them in your trade decision when the market is under trending conditions. When there's a distinct trend, you're able to discern in the market. Again, if the market is consolidating, what ends up happening is that you get a lot of false signals. The moving average will move, they will give you movement, but it's going to be false signals because consolidation is simply not best suited to a moving average. as we indicated earlier in a previous point, it's a trend following indicator. So if a trend is not there, its reliability is significantly reduced. If you understand each of these four components of the definition of a moving average, guys, give me a D in the chat box. If there's any questions you have relative to any of them, tell me that as well. I'll go through it with you again. All right. Maxim is telling me that the chat is severely delayed, so I should probably go ahead. I'm seeing these. All right, great. Let's talk about the basic types of moving averages, guys. So I have already established when I was showing you how to insert the moving average onto your chart, you saw the wide variety of moving averages that there were. As a matter of fact, I didn't even go down the full list of moving averages that existed, but there were about 12 of them that popped up automatically once we typed in moving average. I want to introduce you to two of the most basic, the most common moving averages. And they are common and they're common in the sense that they're reliable. They seem to work really well. Yes, different moving averages will work well for particular trading strategies, but these two moving averages you have here, they can work almost across every trading strategy you want to employ. And that's the reason they are so common. They are basic in the sense that they work across many trading systems and trading strategies that exist. So the two I'm introducing you to tonight would be the simple moving average on the one hand, and it will be the exponential moving average on the other hand. When I was showing you how to insert the moving average onto your chart, remember I told you all that on TradingView, when you see moving average, they are really referring to the simple moving average. Now, if you wanted to insert an exponential moving average onto your chart, all you needed to do was type in moving average right where I typed in moving average before, and exponential gonna come up for you to see. You're gonna see exponential moving average, which I'm sure you did when we last looked, and you will see simple moving average. So you get to choose which one of them that you want to work with. Now let's discuss these two moving averages. Let's point out the benefits and the pitfalls of them both. All right, let's deal with the simple moving average first. How do you come up with a simple moving average? Now, I'm not going to go through the mathematics of how the simple moving average appears on your chart, but I'm going to give you an explanation to underlie it, right? If you say to the charting platform, here's what I want my simple moving average to be set at 50. What that moving average line is going to do, it's going to consider the last 50 candles that closed on your chart. All right. And it's going to average, give you the arithmetic mean, the average price movement of those 50 candles over the time, over the course of your chart view. So it gives each particular, in other words, it is simply an arithmetic mean. They add up the 50 values. If price closed at $1 in the first hour, and then $2 in the second hour, and then $3 in the third hour, well, they will add up 1, 2, and 3, and then divide it by 3 to give you the average. All right. So the simple moving average just gives equal weighting to all 50 candles, assuming you use the 50 period. On the other hand, the exponential moving average works on the logic that I don't need a general indication of what would have taken place over the course of the last 50 candles. What matters most is what is happening most recently in the market. So what the exponential moving average will do, let's just say, assume you use the same 50. What the exponential moving average is going to do for you, it is going to take those last 50 closed candles, and instead it's going to give a greater weighting in working out the average. It's going to weight the more recent closes of the candles more heavily. It's going to give them greater value. It's going to give them greater consideration, so that it gives you a more up-to-date interpretation of what price is doing in the market. All right, let's look at our second point. One of the things about the simple moving average is this: it tends to be a smoother line. And I'm going to show you it on a real chart in a little bit. But follow my explanation first. It tends to be a smoother line because it gives you the average, the arithmetic mean, the movement tends to be smoother. When you look at the line created by the simple moving average, it tends to be smoother than the line created by the exponential moving average. Why? Because the exponential moving average, based on the fact that it's weighted differently, tends to have sharper moves reflected on the line. So the line of the simple moving average is smoother than that of the exponential moving average, simply because the exponential, or the EMA, tends to respond more quickly to movements in price. So let's discuss that bit about movements in price. Because the simple moving average averages out the entire 50 at the same weight, at the same values, equal weighting, sorry, it's slower. Remember, it's averaging all 50 for you, ascribing to each equal weighting. It tends to be slower in detecting changes in the market, whereas the exponential moving average will tend to be quicker in detecting changes in price over the specific period you would have identified. So the simple moving average is smoother but slower. The exponential moving average is a little bit rougher, but it's also quicker to detect changes in general price patterns. All right? Whereas we can think to ourselves, well, here's what, there's a pro and a con aligned to each. Let me deal with each particular con. In the exponential moving average, because it responds more quickly to what's happening in the market, you will get earlier signals. But here's what, you can get more false signals as well. The exponential moving average will give you earlier signals, but it will give you more false signals than the simple moving average. So the simple moving average will be slower, but in being slow, it actually protects you against false moves in the market. So here's the strategy that a lot of persons utilize. What they would normally do to offset that the pro and con attached to each, they will actually merge the both on their chart. They will actually, on their chart, they won't put an exponential moving average alone. They will mix the exponential moving average with a simple moving average. They will use a big simple moving average, meaning a bigger period, like let's say 50, and then they will put a smaller EMA onto that 50, like let's say a 10, let's say a 14. I'm just using random numbers. All right, so that I've given you the characteristics of both the simple and the exponential. I've given you the pros and cons attached to each of them. Now we understand as well a recipe to help you mitigate the weaknesses of them both and capitalize upon their individual strengths. All right, if you can appreciate that, if you get these two, give me an SE in the chat box. If you get everything I would have explained just now, give me an SE in the chat box. Hey, Rowan, I'm now seeing your comments, so I'm not sure what is the part you wanted me to repeat. Just tell me, give me some hint, and I will try to help you out there. Right. So we get that. We get the simple, we get the exponential moving average. Now let's get on to understanding common utilizations of the moving averages. What can they help you with when it comes to your trading? Firstly, they can help you identify trends, and they can help you identify when a trend is going to reverse. Secondly, they can help you determine the strength of a trend. In other words, by knowing the strength of a trend, you know how long you should stay in a position, for example. All right. Or you can, it can help you pick and choose which trades you want to get into. There's this maxim we use in trading. It says the trend is your friend, at least until it bends or ends. All right. So when you know the strength of the trend, you know, and it's your friend, you want to trade with the trend. If you know the strength of the trend, then you know what direction your trade bias should be on. All right. The third common utilization or the third prescription of the moving average, it can help you identify support and resistance areas in the market. And finally, moving averages can help you establish entry and exit points for your trade positions. It can help you identify when to enter the market and when to exit the market. Now, before we move on to anything further, I want to be able to say this to you. Guys, when it comes to moving averages, and ladies, sorry, when it comes to moving averages, there is no magical moving average that works all the time, that is 100% infallible. There's not a magic recipe when it comes to moving averages. I want to impress that upon you. So there are no automatic numbers that I can give you and say to you, hey, use this Jenkins, or hey, Richie, use this, or Barrow, you should use this, or Garris, you should use that, or Joanne, you should use that. They are simply those moving averages, however, that seem to be more effective under certain conditions. And that is what I intend to bring to your attention tonight. I'm going to walk you through the different periods of moving averages that are popularly used that tend to have greater validity. But that does not mean that they are 100% foolproof. So, someone asked the question earlier, is it true that the 50 moving average is the strongest moving average? And that answer can never be a categorical yes. Simply because if the answer was yes, then I would be saying to you the 50 moving average will always give you 100% of the times, it will give you an effective trade decision. When in truth and in fact, there are times the 50 moving average doesn't work. And I'll show you that as well. I'll show you where and when we would have come upon that. All right. Actually, I wanted to show you the difference between the simple and the exponential moving average on the chart. I'm going to do that before I move on. But I just wanted to get that out of the way. There's not a magic number when it comes to moving averages. Moving averages are not 100% infallible. They work well. They can aid your trading decision, but they are best used in conjunction with other technical analysis strategies or tools, such as the trend lines that we taught over the last couple of sessions, the support and resistance strategies we taught, and the candlestick patterns that we would have taught over the last couple of sessions. So I need you to bear that in mind. Let me go to the chart and let me show you the difference between the EMA and the SMA so you could appreciate some of the points that I actually drew to your attention as we were going through the differences. Right. On the euro now, we had some preparatory work to do to ensure that we could at least manage time a bit tonight, right? So I'm going to show you the 200 EMA right here on your screen. All right, this is the 200 EMA. I probably need to show you 200 SMA as well. So let me put up 200 SMA. It's right here for you. So this blue line you're seeing on my screen, that kind of greenish looking line, that is the EMA. That is the 200 EMA. Whereas the green line you're seeing on my screen is the 200 SMA. So the blue is EMA, the green is SME. All right. And I want to show you something. I want to show you how price reacted. I want to, okay, I want to show you this, right, guys? Let me change this. Let me go back and see if I can find the stuff that we prepared for you earlier on. Yeah. So now you know what my chart is showing. I'm going to take out my crosshair and I'm going to use my arrow instead so you can see it more clearly. Here you have Audi USD on the daily chart. You have my blue EMA. The blue is the EMA 200. The green is the MA 200 or the simple moving average 200. I want to show you something. I want you to look at the EMA. When did the EMA, now if you notice all before here, follow my cursor. This section of price that I'm looking at, it was obvious that we were in an uptrend. But then Audi USD decided to trend down. I want you to look and see which of the MAs, because they are both moving averages, which of the MAs responded more quickly. Look at this. Do you see that the blue line gave you a sudden jerk downwards? And it actually did that. So at the point in time when the blue or the EMA started to head downwards, what was happening to the simple moving average? It was still flat. It was not pointing downwards. In other words, price got all the way down here. Price had already started trending down. It was up all the time. It suddenly started to push down. The EMA picked it up first. The EMA picked it up first. The EMA started pointing down first. And then after a bit, the SMA, the simple moving average, started pointing down. But the simple moving average was later than the EMA. And that was one of the characteristics we spoke about in the past. Look at something else on this chart, right? So it had Audi USD from the uptrend, it went into the downtrend, then it went back into an uptrend. Look at which of the MAs responded more quickly. The EMA, which is the blue line, suddenly gave me a jolt up. And at the point that the jolt came, it's marked off by this blue line as well. So the jolt probably came around here. So the EMA alerted me first and foremost to the fact that Audi USD was no longer going down. It was actually turning up. The moving average turned up. The EMA turned up first. It took a good while for the simple moving average to turn up. It continued to go down. Follow my little cursor. It continued to go down. And it was only around here that I actually started to see a move upward. So the SMA was actually slower in telling me what was happening, in telling me when the trend was going to change in terms of these particular settings, these particular MEs. EMA on the one hand and MA on the other hand. So I needed to show you. EMA is quicker, SMA is slower. I need you to just look at the line as well. In truth and in fact, the green line is a much smoother flow than the blue line, which seems to be a little bit jaggedy. We spoke about that. The reason the blue line is jaggedy is because it responds to price movement more quickly. The simple moving average responds more slowly, so you get a smoother line at the end of the day. All right? Let me just check the chat box and I'll get back. We'll continue the rest of the content. All right, guys. So let's get started. Let's go through first and foremost point one. So we're going to break these into sections. We're going to deal first and foremost with how you can use the moving average to identify a trend and identify trend reversals. You probably got an insight into it already, but we're going to go into it in substantially more detail here. So on my screen, guys, I have some information for you. Basically, what this chart is saying to you is this. Different periods of MAs help you identify different types of trends. When we taught trends, we taught you about the long-term trends, the intermediate trends, and the short-term trends. There are different moving average periods that can better help you identify these varying trends. All right? We did say there's no magic number, but there are different MA settings that seem to work well to help you identify different types of trends. For example, if you are trying to establish the long-term trend, setting a moving average between 100 to 200 will normally do the trick for you. Setting a moving average between 100 and 200 will normally do the trick for you. And I'll tell you this. You see that 200. So some people use 100. You could use any figure in between there. A lot of people use 100. Much more people use 200. And then there are those people that look at the 150 as well. As I tell you, there's no magic number. So these figures are given to you in ranges just to show you. So you might find someone using 145 and somebody else using 174. It doesn't mean the 174 more accurate than the 145. The fact is, a moving average that might be suitable this hour, this day may not be suitable the next day. That's just how it is. As market conditions change, different moving averages become more applicable and some of them become less applicable. There are those, however, that seem to stand the test of time, and that is a reflection of the information I'm giving you. So as I said, long-term trends are more easily identified by your 100 and your 200 moving average. That can be either the simple moving average or the EMA. Personally, I have a preference for the EMAs, but that's just my personal preference. I like the fact that it considers more recent price action more closely or more heavily. So I tend to like EMAs. That doesn't mean I don't use SMAs, but I tend to prefer EMAs. All right, I'll tell you something else about the 200 EMA. A whole lot of persons in the market tend to prefer the 200 EMA as well. It almost becomes a self-fulfilling prophecy. In trading, there's something we call crowd psychology. In other words, sometimes price reacts to certain things strictly because most of us make certain decisions at those levels. For those of you that were on my support and resistance training, you remember I taught you about psychological levels. Why are psychological levels support and resistance areas? It's just because people have an affinity, a gravitation towards those particular numbers. And over time, the 200 EMA, persons tend to have an affinity towards that. They expect significant trading decisions to be made at that particular point. So you tend to find the 200 EMA or the 200 MA having renowned value. It really does stand the test of time. I want to show you it on a chart, for example, right? How the 200 EMA actually does work to help you figure out the long-term trend. Let me pull up a chart for you. And you know what? I can just take out the MA on this chart and show you it right here. I want to work with the EMA. I told you that's what I like, right? This is the 200 EMA. Here's the logic of how the thing works. If you have a 200 MA on your chart, whether it's an EMA or an SMA, once price trades above that 200 MA, then you're under buying conditions. Whenever price trends, so as you can see here in AUD USD, we were buying. Why? Because price was moving above the 200 MA consistently. In this case, it's the 200 EMA. Look at this portion of AUD USD. Do you see that price was trading below the 200 EMA for quite a bit? Then this would have helped us recognize a downtrend. So you can use your EMA to help you identify what trend is occurring in the market. As you see here, Once price remains above the EMA, the 200 EMA, then it's buying conditions. Once it goes below the 200 EMA, then it's selling conditions. Let me pull up the 100 EMA and give you an example of that as well. This is my 100 EMA, right? Similarly, once price went below the 100 EMA, we were in selling conditions. We were in a sell trend, a downtrend. Once price broke that downtrend, it broke the EMA and went above and continued to remain above, then we were in buying conditions. If I were using this EMA to trade, whenever price beating around the EMA like that, I will be cautious. As a matter of fact, I want you to recognize something. This period that you see the setup beating around, where the market was kind of going up and down, over and under, it was actually a consolidation period. There was not a clear identification of higher highs and lower lows. The market seemed to have simply been ranging. All right. So remember, I was telling you all a while ago that the moving averages work best in trending conditions. Definitely, it worked here to tell us the market was trending downwards here and it remained below the EMA. It was trending upwards here, it remained above the EMA. But there was actually no trend in place there. I couldn't draw a line down sloping. I wasn't having lower lows, lower highs, lower lows. Neither was I having higher highs, higher lows. So it was actually a period of consolidation here, and it was during that consolidation I keep getting it flipping under and over, under and over, under and over. So this actually beautifully demonstrates the point I was making to you all a short while ago about being able to use your moving averages under trending conditions only. If you get that, guys, and if you can appreciate how you can use the MA to help identify the trend, give me a T in the chat box. I'm going to continue on it, but give me a T if you have a preliminary understanding thus far. Uncle Chosen, I covered that earlier on in the session. Perhaps if you catch the recording, you'll get it. But here's what. Once I get back onto the chart to show something else, I will go through how to insert it again. But I did that to start the session off. So if you preliminarily understand how the MA can be used to assist identification of the trend, give me a T in the chat box. Preliminarily. Right. Now, a long-term trend might be something the position trader is actively interested in. As a matter of fact, every type of trader will be interested in it, but more so the traders that hold trades for months, that treat a trade as an investment, all right, months upon months. So that works well for them. But what if you're the type of trader that's probably a swing trader? You're willing to hold it for days, perhaps weeks. What are the moving average periods that you can look at setting onto your charts? Well, you can use as a swing trader the periods that tend to work effectively are between 26 to 100. Ultimately, it's really 26 to 99 because remember the 100 was already in long term, right? So that's just a bit of redundancy. So it's between 26 to, I'm saying 100 to be able to capture that redundancy. But you'd notice I have a red line. Why do I have a red line? I have a red line to make the distinction between intermediate traders that would prefer to stay in the market a shorter period of time versus those intermediate traders that don't mind staying in the market a longer period of time. So if you know you're a swing trader, but you don't like to swing for very long, the moving average periods that can work for you would be 26 to 49, anywhere between 26 to 49. All right, those are some of the moving averages that work well for the swing trader that don't like to stay in the market for weeks on end. They probably a week maximum is what they like. So they'd use something like the 28 moving average. They might use something like the 35. You can use any moving average within that time frame. For those swing traders, however, that don't mind staying for weeks, staying in a trade for weeks on end, between the 50 and the 100 moving average tends to work for you. All right? The 50 and the 100 moving average tends to work really very well for those traders. I see some questions coming in. I will just field those first and then we'll move on. I love the 50. Let me say that. I love the 200. I like the 50. So in the two categories that we've covered so far, the ones that I tend to gravitate to, 200 and 50. Those are the ones I use. Those are the ones that work well for me. That, however, is based on my trading style. It's based on the amount of days, the amount of time I like to stay. I don't mind staying in a trade. All right. So that works for me. You'd pick the period that seems to work with your lifestyle, with your trading personality. All right. Let's talk about the short-term trends. I was just getting a series of responses. I guess. Let's talk about those persons that are in the market, like intraday traders, or even, I don't think necessarily scalp traders. I will say more of an intraday trader. Intraday traders tend to use moving average periods from 5 to 25. All right. Again, I have a red line. Why is that red line there? To show you the distinction or the separation between periods that apply for those persons that prefer to stay in the market a day and slightly above a day, and those persons that really want to be out of the market within a day. So within a day or so, you find persons using the 5, between the 5 to the 13. Those are the periods they tend to utilize. If you're willing to stay in the market a day, but you don't mind going a little over a day, then between the 14 and the 25 could work for you. What do I like if I were using short-term moving averages? Well, I like things like the 21, I like the 14, I like the 9, I like the 13. So I use the 9, I use the 13, I like the 21 if I'm trading that more intraday perspective. Those are some of the ones that I would utilize. But guys, in a nutshell, those are the moving averages that tend to be utilized. Those are the periods that tend to be utilized depending on the trend you are trying to ride. If the trend is your friend and you're a trader that prefer to err on the side of caution, how would you be able to identify the trend? Of course, you can do your trend lines, but on top of doing your trend lines, if you can actually get your moving averages to confirm what your trend lines are saying, then you're good to go. As a matter of fact, I tell you that sometimes you can look at a chart and you can see where on the same chart you're able to pull a uptrend line and a downtrend line, and you're confused, you don't know what next. Well, the moving average can be used to help filter out that noise for you. So if the moving average is below price, if you have both a downtrend line and an uptrend line, but the moving average is below price, then you know it's really the uptrend line that seems to be predominating, meaning the buying conditions are what ruling the market for the time being. All right, so that can really help you filter out some of the noise, and that's one of the benefits of the moving average. If you guys understand these different time frames, guys, if you can appreciate the periods that I identified for you, if you think it can help you make a wiser decision in terms of what periods to use depending on the time frames or the style of trading, you do give me a TF in the chat box. If you have any questions, give me them as well. I'll respond to them as best as I can. I want to finish this section off, which is the section that looks at trends and trend reversals. And once I do, we'll close up there for the night. We'll continue with the other portions of the session in subsequent sessions. But I really do want to finish this at least so that you have something meaningful to go away with. Sharon, again, there's Oh, Sharon, you're asking me if you can mix an EMA and an SME. That is actually a strategy I'll be teaching you all a little while in a little bit to come. So sometimes I use both. In other words, I told you I like EMAs. So normally if I'll use the 50 and the 100 EMA. But there actually is a strategy. Remember on the previous slide, we were talking about the fact that to offset the weaknesses, to mitigate the weaknesses of both the simple and the exponential, you can employ both of them. So yes, it's entirely possible for you to be able to mix a bigger SMA with a smaller EMA. Yes, that is possible. All right, I'm continuing. Guys, I want to tell you something. In deciding those periods, I want to show you how useful. In other words, it's like the market to me, I just love the structure. I love market structure. And there's something about your moving average periods that can be confirmed via your Fibonacci levels, your Fib sequence. I want to talk to you about that a little bit. So we talking about how you can use the moving averages to help identify the trend. The question becomes in doing that, well, what periods should I utilize? And I gave you the periods that you can seek to utilize. But I want to drill down and give you some further options. You can actually utilize periods that coincide with your fib levels. But in order for me to make sure you thoroughly understand that, I needed to go back to the basics of fibs to demonstrate this for you. All right? So, what is Fibonacci levels all about? It was a discovery made by Leonardo da Pisa, and he was able to show. Here's what he said: it's a numerical sequence. He was a It's a mathematical sequence. He said it's a mathematical sequence that actually permeates every area of our existence as human beings. It is not unique to the Forex market, but it has proven its utility in the Forex market. He says when you look at buildings, the construction and the designs of buildings, certain buildings are actually based on Fibonacci levels. He said when you look at certain plants, the design of the flowers, the design of the plant itself is based on Fibonacci levels. He said every part of the world, every aspect of the world you look at, there's something about the structure and the design of the systems and the atmosphere around us that redound, that speak to Fibonacci levels. And he was able to show the usefulness of the Fibonacci levels and the Fibonacci sequence, even in Forex trading. So here's what I need you to understand about the Fibonacci sequence. The Fibonacci sequence starts with the numbers 0 and 1, right? Now, the man was a mathematician, but we're not getting into the big maths of it, right? He was the first and the greatest original mathematician of Europe. We're not going to get into all of the details. I just need for you to get an understanding. He starts the Fibonacci sequence with 0 and 1. And he says, here's what. To come up with the rest of the numbers in his sequence, each number, each subsequent number is the sum of the previous two. So if I started with 0 and 1, 0 plus 1 is equal to what? 1. See that? The Fibonacci sequence started with 0 and 1. It's the next number in the sequence will be the sum of the two previous numbers. So 0 and 1 is 1. How do I know what comes after this one? Well, it will be the sum of these two preceding numbers. 1 and 1 is 2. How do I know what comes after the 2? It will be the sum of the 2 plus the number before it. So 2 and 1 is 3. How would I know what comes after the 3? 3 and 2 is 5. After the 5, what should come? I simply add the 5 to the number before it. 5 and 3 is 8. How would I know what comes after the 8? 8 and 5 is 13. How would I know what comes after the 13? 13 and 8 is 21. And he worked that sequence down to some of these numbers you're seeing here. But you can work it out yourself, the fullness of it yourself. By now, I trust that I would have been able to explain the sequence. if you understand the Fibonacci sequence and how he came up with it, how the sequence itself was fleshed out. Give me a F for fibs. Give me a F for fibs. Right. Now all you see the sequence, right? And all them have been saying, but I baby thing until I come up with that one. Let me tell all you what's additionally brilliant about this sequence, right, guys? And I'm just throwing this in and not going to detail it. Here's what's remarkable about this sequence. Each number, each subsequent number, so you see the sequence says 1, 2, 3, 5, 8, 13. Each subsequent number is approximately 1.618 times greater than the one before it. So each of the numbers in the sequence actually is, each of the later numbers is 1.618 times greater than the number before it. All you would have to do is divide the last number by the number before it and you'll be able to come up with the figure. So that's why when we talk in fibs, you know, the 61.8 level is always a level as your traders talk about. It's just because it seems to be this magic number that redounds throughout the entire sequence. You know, the Fibonacci sequence is such a beautiful thing. It blows my mind. It speaks to my style of learning and stuff like that, guys. But that's basically the essence of it. Now, so you see this sequence here. At least you see some of the numbers in the sequence here. Well, guess what? You can decide to add greater validity to your moving average periods. You could decide to plot moving average periods based on your different fib levels. So if I were you, I'll just take a picture of the fib levels, because when we go on to the other slide, you'll see how some of these levels can actually be utilized to help set your moving average levels. Let me show you that. What you do when you do something like this, when you're able to apply Fibonacci levels to help identify your moving average periods, is that you create what I might want to call confluence. There's a greater merit you give to the different the periods you're ascribing to the MAs. So here are some of the popularly used fib levels that are applied to your moving averages. For example, 8, 21, and 89. Those three Fibonacci levels are normally applied to moving average levels. They are normally used together. Other persons would use 5, 8, 13, and 21. So they will apply moving averages at those 4 periods and work with that to help their trading decisions. Other persons tend to use 13, 34, and 55. I like 55 as well. I like, so of these numbers, I like 21, I like 13, I like 55. I like, it really is a matter of your preference depending on how long you like to stay in a trade. But I needed to give you this information so that you'd have some additional basis upon which you can decide on the periods to be utilized. Here's what I want to tell you though. Here's what I want to tell you. You're seeing two words there that I've not spoken about before for the night: stacked and sloped. Whenever you apply these moving averages at these levels on your chart and they line up in a certain way, they can help you identify the trend with amazing accuracy. I want to show you an example of it. So whenever you can apply these combination of fibs and they line up on your charts a certain way, they help you identify the trend with an amazing level of accuracy. I'm going to pull up the charts and I'm going to show you. Again, we did some preparatory works to make sure we wouldn't have to be just scanning through a whole lot of stuff. We're at GBP CAD, and we're gonna go to the daily time frame on GBP CAD. I'm on the daily time frame, and I'm gonna use the 8, the 21, and the 89. All right, so I'm gonna use the 8. I'm taking out the 100 MA. I'm replacing it with the 8 EMA instead. So this is how I did it. Let me just show the person that said they didn't know how to put on the MA, and let me show you how to do it. I'm going to take mine off of the screen, right? I'm going to take mine off, and I'm going to put it on again. I go to the top of my screen, I look for indicators. When the indicator dialog box comes up, I type in moving average, and exponential moving average will come in. I click on exponential moving average, and it appears on my screen. When it appears on my screen, it will appear at its default setting, which is 9 close. I want it to be set at 8. I want it to be set at 8. So all I do, I go to my gearbox or my settings tab, and I change the length to 8, and I OK it. I also need to change the, I'm going to make it a little bit thicker so that you all can see better, right? So my 8 EMA is actually here. I'm going to take off my 100 EMA, my 100 MA as well. I'm not taking it off, I'm just changing it actually. I'm changing it to 21. So my inputs, instead of 100, I change it to 21, and I OK it. And then I'm going to take off my 200 MA. I'm going to change that to 89. And I'm OKing it. Oh man, that was an MA, that wasn't an EMA. Let me do all at MAs then and see if I can work with that instead. I'll do all at MAs. So let me just, because 2 of them are MAs, 1 is EMA. So let me close off the EMA, and I'll add in the MA instead. So moving average. So the person that didn't know where to put it in, you have another opportunity to see it. Moving average. Click on moving average. It was added to my chart. Oh, I just changed the period to 8. And I add it. I think I need to make it thick so that you all can see. So now I have the 3 of them there. I have my pink, I need to change that color. It's too close. The pink is too close to the orange. You're not seeing it well. So I'm going to put a yellow. I have the yellow, I have the pink, and I have the orange. Now, here's what I want you to look at. Here's what I want you to see. When I have these 3 moving averages, as they are, whenever the biggest of them is below price, the second is, so I have 21 as my purple. I have 89. The 89 isn't showing, sorry. I have 21, 89. I have one that shouldn't be showing. Let me hide this. I have 8, 21, and 89. These are my 3 Fibonacci levels that I utilize. Whenever you have them in such a way that the biggest to the bottom, the middle length to the middle, the small length to the top, and price above all 3, then that is an indication of what we call a stacked and sloped trend, meaning it's a strong uptrend. Let's see if we can see any of that taking place on GBP CAD? Is there ever a point where price is actually above or below all three? Look at this. Are you seeing at this particular point here? The highest, the 89 is the green, the purple is the 21, and the 8 is the yellow. Are you seeing the highest above, the middle line in the middle number in the middle, and the lowest number at the bottom, and price is below all three? When this occurs, whenever they're stacked above each other in their numerical order, and price remains below them, that's indication of a strong sell. If I had gotten it in the opposite direction, where price was actually above them and they were stacked like that, like for example here, the green is to the bottom, the purple is to the middle, the yellow is to the top, and price is above all three of them. They are stacked in their numerical sequence and price is above them. Then that's an indication of a strong buy. So if you're the sort of trader that wants to be absolutely sure something buying or selling, you can apply this stacked method approach, and that will help you make a decision as to whether or not, yes, the market truly in a strong buy or a strong sell. All right, whenever you see that they flip flop and they're not in that numerical sequence, that's an indication that the market's a little bit jerky. You don't have a confirmed trend. But look here again. You got another indication of a really strong buy. They in stacked order. Price remained above them, and therefore the market was buying heavily. It was trending heavily. If you notice, they all confused here. They're wrapping up, they're tying up. That's because the market wasn't trending. It was simply in consolidation. What was happening here? They're in stacked order here. Highest at the top, lowest at the bottom, and price remains below it. Strong sell. That is what we refer to as stacked and sloped in the market. All right, and you could have applied any of these combinations that I gave you. If you see that general formation of the combinations coming together, then that is what will indicate to you that there's strong trending conditions in the market. If you get that, guys, if you get stacked and slope, give me SS in the chat box. If you understand the concept of the market being stacked and slope, give me a SS in the chat box. Yeah, okay, great. All right. I want to show you, so far we have been we've been talking about how to use the moving average to assist your trend. We've also spoken about how to identify the strength of the trend based on how the moving averages line up, based on whether they stacked with the lowest, with the in numerical order. So we spoke about how to use them to identify the trend and the trend reversal, because obviously when it breaches, if it was up all the time and it goes down, up, breaches the EMA and goes down, then it's starting to sell. So it's reversing, the market is reversing. Here we spoke to the concept of the market being stacked. I want to show you one other strategy for determining the strength of the trend using your moving average. And I'm going to go back to the chart to do that. It can work on all time frames, Flora. All. It doesn't matter what the time frame is. I'm going to go back to the chart. And this time I'm going to show you how the EMA 5 works to give you a strong trend, yes or no. I'm going to take you to how the EMA 5. So I'm going to hide these other MAs so that they don't confuse you. And I'm going to show you only the EMA 5. Right? And I'm going to go to CAD JPY, and it was actually on the weekly chart that Max was able to identify it. I'm going to show you something. Whenever you apply a very small moving average to your chart, guys, it can help you, and price remains above or below that very small moving average, then it's an indication of a strong trend as well. So there are two things that it can indicate a strong trend. If it's stacked and sloped, or if you use a very small moving average, a very small period, and yet price stays above it or below it. And this was the example that we have here for you. CAD JPY. Are you noticing that that EMA is very, very close to price? So close that price frequently goes above and below it before. But look at this period of time here. EMA 5 went below price and stayed below price. Because it's such a small moving average, you would have expected it to keep cutting through price regularly. And it did that for quite a while. However, at around this juncture, it went below price and stayed below price for approximately 3, 4, 5, 6, 7, 8, approximately 8 weeks, because this is a weekly chart. Once you see a very small moving average, like 5, going below price and staying under price consistently, then that is an indication of a strong, what kind of trend would this have been? Well, if price is above it, it means this is a buy trend. But if you look on this other side right here, the EMA 5, it went through a number of candles after that. After this period of the strong buy, it went through a number of candles. But then it went above these candles here and stayed hugging the top of it for quite a while, for about 1, 2, 3, 4, 5, 6 weeks. It means this was an indication of a strong sell. So whenever small MAs are applied to your chart and it doesn't cut through the price, but it stays either above the price or below the price consistently for a period, then that is considered an indication of a strong trend as well. All right, guys. So I am not finished with trend identification and trend strength, but I will want to close off there tonight in the interest of you guys. I know it's the end of the year and I know your schedules are probably busy. We've been on for an hour and a half, which is typically the length that we go to, sometimes longer, never shorter. Um, but I think I want to close off there tonight. If you all are willing to stay on and you want me to continue, depending on the numbers, I can. There's just one other thing I need to show you actually. So let me show you that one other thing. Let's not. Let me get feedback from you all here. Let me do make the decision. You make the decision. Do you all want to stay on for a couple more minutes, or do you all want us to close off here? And on Tuesday we'll continue. We'll continue at looking at how the trend can be identified and the trend reversals can be identified using your moving averages. CJ Yoma, I'm not at the point where I can show you where to enter trades yet. There's some groundwork I need to cover for you to be able to understand when to enter the trades. All right, so some people aren't writing me on the chat box, but they're blowing up my phone and saying continue. So let me finish this and then we'll go, guys. All right. I want to talk to you about the possibility of using not just one MA, but two MAs to assist your trend identification. So I've shown you all night how to use one. but there tends to be a certain weight ascribed to using more than one MA on your chart. And so, yes, we understand how to use one MA to identify a trend. I showed you the 200, I showed you the 100, I gave you the periods depending on the type of trend you wanted to identify. But I also showed you the stacked and slope system. The stacked and slope system was you using multiple MAs. What about those of you that can't use more than three? Could you also be able to identify a system of a good trend, of a reliable trend, using the free version of TradingView where you only allow 3 AMAs? The answer is yes. There is a system we call the dual MA crossover that can help you identify your trends. I'm going to talk to you about it tonight. It's typically utilized via the crossing of your 200 moving average with your 50 moving average. And that can be either simple moving average or an exponential moving average. It doesn't matter. But there's a particular technical term given to it that I want to go through with you tonight. It's known as the death cross and the golden cross. So I need to talk to you about this. Here's what the death cross is. And before I delve into the details, let me just explain this. The coordinates, the period 20 and 50, are the most popularly validated periods for the death cross and the golden cross. However, it does come with some controversy. That is to say, there are those persons out there that call any cross of a big and a small moving average a death cross and a golden cross. Once it crosses down, once a small average cross downwards of a big average, they call that a dead cross. Once a small average crosses upwards on a bigger moving average, they call that a golden cross. So there are persons that use the terminology of dead cross and golden cross quite loosely. However, the most popular understanding, the most accepted understanding of what a dead cross and a golden cross is when your 50 moving average crosses your 200 moving average. If that 50 moving average crosses and goes below the 200 moving average, that is known as the death cross. It means you've just gotten a strong bearish signal. And once that small moving average of 50 crosses below that big moving average at 200, it's usually an indication that a prior uptrend has ended and now a long-term downtrend is set in motion. So it's called the death cross because buyers are now deemed to be dead to the market. It's now going on a long-term sell. The crossing of the 50 below the 200 is known as the death cross. Whereas if that small moving average or that 50 moving average crosses and goes above the 200 moving average, it is considered to be a golden cross. It means we're ready to buy. Why the word golden? Because in trading, it has been proven that buy trends last longer than sell trends. And it's golden because we like to be able to ride a trend. So if a buy trend lasts longer than a sell trend, then that's a golden opportunity for us to ride a trend. So whenever the 50 crosses upwards of the 200 moving average, it is deemed as a very strong bullish signal in the market. It means the market is ready to buy. It means the preceding downtrend would have ended and you're going towards a long-term uptrend. All right, guys? But to just elaborate on one point, I'm going to show you it on the charts. To elaborate on one point, though, I want to say this. There are actually some persons that look at the cross between the 50 and the 100 as opposed to the 200. And they call that the silver cross. Whenever the 50 crosses the 100, they call it the silver cross. I can't vouch for its reliability because it's not something that I use, but a couple of traders that seem to be reputable have spoken about it. My problem with it is this. It's called the silver cross only when it cross up, when the 50 grows upwards of the 100. But if it goes downwards of the 100, they don't have a name for that. And to me, I just don't find that logical. So I don't ascribe to the silver cross, but it is information you'd want to have in the event that you want to make a decision off of it. Notwithstanding, the dead cross and the golden cross here are utilized in instances of the 50 and the 200 more often than not. So let me find it on the chart and show you. I'm going to go to USD CAD. I'm going to go to the 4-hour chart. I'm going to make sure my 200, I have to change after. So I'm going to make sure, I'm going to hide these. I'm going to make sure that my 50 EMA, you can see it, that's the yellow line there. And now I'm going to have to put on my 200 EMA. I'm going to change the period to 200. I'm going to just make the line thicker first. And I'm going to change the period to 200. Normally the MAs are applied at the close, even though you can apply them at different levels. And I want to show you an example. Max was so kind, he marked them off. And look at this. What was happening is that prior to this cross down, the market had been in a period of consolidation. And suddenly our 50 EMA crossed below our 200 EMA to give us our dead cross. Did it, the market, remember we said a dead cross is an indication, or it's a signal that the market is going to sell off. Did it sell off? Indeed it did. The market continued to sell from where it was. Let me just measure that pip movement. From the time we got this signal, the market sold off 157 pips or so. And this is just on a 4-hour chart. So this was an example of a dead cross. Then we got the cross again, but in the opposite direction. The 50 EMA crossed above the 200 EMA, giving us a golden cross. Let's see how much did the market start to buy then. It absolutely did. Look, it's kept on buying. Once we got that cross, the market continued to buy. How much pips of movement have we gotten thus far on the buy? Now it hasn't crossed back down yet, so it means it hasn't started selling off yet. Not in a meaningful way for us. Anyway, we got approximately, I'm not seeing it, 125, 130 pips or thereabout when we got the golden cross. All right, and now the market is making a decision. They're coming very close to each other. So pretty soon we'll see a decision as to whether or not the 50 EMA wants to go below the 200 EMA to give us a sell-off. But there you have a simple and effective example of both your dead cross and your golden cross taking place. Your 50 and your 200 moving averages. Again, they help you identify the trend direction. Once you get a dead cross, then it's an indication of a sell-off. Once you get a golden cross, it's an indication that the market is going to be buying. And on to the last bit of content for the night before we close off. I think CJ Yoma, you asked me that already. There's some groundwork I need to cover before, in other words, I need to teach you trend identification and trend reversals, which we'll be doing tonight. I need to teach you the strength of the trend, which we did tonight. I need to do support and resistance with you before I can go on to doing trade entries and exits. So that will come in upcoming sessions. I use the EMA there, CJOMA, just because it's the more important. That's the one I prefer to use, sorry. But you could have used the MA as well. It all depends on your preference. I have shown you the death cross, but I want you to know there are other crosses you can look for that are equally reliable. For example, some of the crosses that work pretty well are the crosses of the 5 and the 55. If you notice, there's a big and a small. So the crosses will always be of a bigger period and a smaller period. The 55 and the 5 work really well. The 26 and the 9, they work very well to show you trend direction and changes in the trend. And remember earlier on, we had spoken about mixing your EMA and your SMA. We were going to make the SMA big and the EMA small in that one. But there's actually a crossover, guys, that is used by one of our traders on the Gold Cup application. There is a strategy by Lizaldo that he uses, and he uses the cross between the 50 EMA and the 4 SMA. And he uses it more so as an indication to tell you when not to take a teacup. Remember, his teacups are always based on sell trades that he envisaged in the market. But he said once you have that 50 and 4, that 50 EMA and that 4 SMA crossing up, the 4 SMA going above the 50 EMA, he said don't take the trade. So he actually uses the 50 and the 4, and I've been following that for a while, and it seems to be really very effective. So whereas you can use two SMAs and two EMAs, you can also mix it. And that 50 EMA coupled with that 4 SMA, it is one of the mixes that tends to work well to helping you identify exactly when to enter. Or for the person that asks when to enter, when you see the cross taking place, I will get into entries and exits in more detail. But when the cross takes place, wait for the candle to close and you can get in. But if you want to be really very safe, wait for the candle to close. When the cross occurred, wait for that candle to cross and wait for one other candle to cross. So you will be actually be getting in on the second candle after the cross. So you can either get in when the candle close, your cross comes and that candle close, you could get in. Or you could wait for one other candle to close in the direction of the cross and you could get in. All right? That's just a basic explanation. I'll be getting into it in significant detail. All right, great. All right, guys. So that's where I'd want to close off for tonight. We've taken a look at what are moving averages. We've spoken about the different types of moving averages, the pros and cons, the characteristics of each. We've spoken about using moving averages for trend identification. I taught you some of the different periods that are aligned to different types of trends you're looking for. I taught you about using fibs in conjunction with your moving average to get an even clearer, more convincing indication of the trend. I taught you as well how to mix your moving averages to get a clearer identification of the trend. We learned the stacked and slope. We learned the dual MA crossover methodology. So I need you to go over this information. It's a lot, but it can really be useful in your trading decision. On the next day, which is Tuesday, we'll continue our look at moving averages. Again, we will not be able to complete because I plan to continue this for at least 4 sessions. So we'll continue our look at moving averages on Tuesday. But if you thought this session to be valuable to you thus far, give me a rating on a scale of 1 to 5, 1 being the lowest, 5 being the highest. Remember too that we do have a feedback loop that you can enter your feedback into. It really does help us shape our content. It determines, for example, this topic on moving averages, it was a topic we had not done previously that persons asked for, so we included it this time around. So your comments as to whether you think it to be valuable or invaluable, or any adjustments, any will determine whether or not we keep it on our curriculum, yes or no. So do let us know. Emmanuel, who's asking me about the pips, you'll need to wait until I go through entries and exits in detail to determine that, right? Nigel, you're welcome. Richard, thank you very much. Chase, good night. All right, guys. So we'll call it a night there. We've covered a substantial amount of information, meaningful information. Join me on Tuesday night at 10 at 9:30 Eastern Time, where we'll continue our look at moving averages. But don't forget, we have our live trading session on Tuesday morning at 7:30 Eastern, where we look for live trade setups in the market. Mickey, I like your pun.